In the city, they sell and buy, and nobody ever asks them why. But since it contents them to buy and sell, God forgive them, they might as well. Humbert Wolff, The Uncelestial City, 1930. Anyone passing the skyscrapers of Wall Street or the City of London will be impressed by the scale and scope of modern finance. Logos display familiar names such as Citigroup and HSBC. More discreet brass plates identify organizations that do not deal with the general public. The most important headquarters building in the industry, the head office of Goldman Sachs at 200 West Main Street in Manhattan, remains anonymous. The premises are lavish, the limousines ubiquitous. Individuals with offices in the executive suites earn more in a month than most people will expect in a lifetime. But what do these people do? To an extent that staggers the imagination, they deal with each other. In most Western economies today, the assets and liabilities of banks exceed the assets and liabilities of the government and the aggregate annual income of everyone in the country. But these assets and liabilities are mainly obligations from and to other financial institutions. Lending to firms and individuals engaged in the production of goods and services, which most people would imagine was the principal business of a bank, amounts to less than 10% of that total. See Chapter 6. In Britain, with a particularly active financial sector, that figure is less than 3%. Modern banks, and most other financial institutions, trade in securities, and the growth of such trade is the main explanation of the growth of the finance sector. The finance sector establishes claims against assets, the operating assets and future profits of a company, or the physical property and prospective earnings of an individual, and almost any such claim can be turned into a tradable security. High-frequency trading is undertaken by computers which are constantly offering to buy and sell securities. The interval for which these securities are held by their owner may, literally, be shorter than the blink of an eye. Spread Networks, a telecom provider, has recently built a link through the Appalachian Mountains to reduce the time taken to transmit data between New York and Chicago by less than 1 millisecond. World trade has expanded, but trading in foreign exchange has grown much faster. The value of daily foreign exchange transactions is almost 100 times the value of daily international trade in goods and services. Fedwire, the payments mechanism operated by the U.S. Federal Reserve System, processes more than $2 trillion of transfers every day, about 50 times the U.S. national income. Trade in securities has grown rapidly, but the explosion in the volume of financial activity is largely attributable to the development of markets in derivatives, so-called because their value is derived from the value of other securities. If securities are claims on assets, derivative securities are claims on other securities, and their value depends on the price and ultimately on the value of these underlying securities. Once you have created derivative securities, you can create further layers of derivative securities, whose values are dependent on the values of other derivative securities, and so on. The value of the assets underlying current derivative contracts outstanding is 3 times the value of all the physical assets in the world. What is all this for? What is the purpose of this activity, and why is it so profitable? Common sense suggests that if a closed circle of people continuously exchange bits of paper with each other, the total value of these bits of paper will not change much, if at all. If some members of that closed circle make extraordinary profits, these profits can only be made at the expense of other members of the same circle. Common sense suggests that this activity leaves the value of the traded assets little changed, and cannot, taken as a whole, make money. What exactly is wrong with this common sense perspective? Not much, I will conclude. But to justify that conclusion, it will be necessary to examine the activities of the finance sector and the ways in which it does, or might, make our lives better and our businesses more efficient. Assessing the economic contribution of the industry is complex, because there are many difficulties in interpreting reported information about the output and profitability of financial sector activities.